So in this question, we've been asked to get the NPV. Okay, and of course, in part B, you advise whether it's a good investment or not. Then Roman 2, you use the discounted payback period, and you determine whether the company is a good investment or not. Okay, so let's do it together. Don't forget this to be second C. Therefore, you'll be doing so through the use of Excel. Okay, so let's present using Excel. I always prefer my workings to be in thousands, so I don't know. Yeah, I'll propose you do the same. Okay, that's my what I prefer. Just in case you make a mistake, you can go to identify very quickly if you have made a mistake. So here we can begin by getting we told the selling price, the variable cost, fixed cost as follow, and the selling price is before 4% inflation. Variable cost is before 30% inflation. So if we can get there, we need to get the contribution. Okay, the contribution we earned. Okay, so then I have this to be year 1 to be year 2, year 3, year 4. I prefer my workings to be horizontally, okay, not vertical. I've mentioned this in the okay. Therefore, we can have here year 1 to be here the contribution per unit. Contribution per unit. You can do the total contribution, but in case you think you're going to make a mistake, do one by one. Selling price, you do have it own working. So instead of having here selling contribution, you have selling price. Then you have variable cost. If you think you're going to make a mistake based on you doing one working at a go, okay? If you think that you can make a mistake, this is much better. It's much safer, okay? Then here you have contribution per unit, okay? You don't lose a lot of time, okay? But it's okay. You can do this, okay? Per unit, or you simply go to and get the contribution per unit straight away, okay? Whatever you prefer, there's no harm, okay? And therefore, the selling price, I don't prefer this way myself, okay? I'll simply go and get the contribution per unit, okay? Which will be equal to the selling price, okay? In free selling price. And let's do it, there's no harm, okay? They won't take a lot of time. But in case you're confident that your formula won't have a mistake, then you can simply go and give the total contribution, okay? Using one formula, okay? Simply using one formula. Selling price will be equal to the selling price as at year, this price are current price term, and the selling price for year 1 is for the years, by the way, they're all equal to $30. Therefore, it'll be equal to $30. This is year 1, therefore, however, there's a 4% inflation. This 4%. Yes, there's a 4% inflation. Okay, therefore, to the power of 1. Okay, for the selling price for year 1. Okay, I was saying, in case you're confident, you can simply go and also now less the variable cost minus the variable cost. Okay, if you're confident only in one formula. Okay, but if not, then do step by step. Okay, like for selling price for year 1, variable cost for year 1 will be equal to it is equal to $10. Okay, in current price term. Okay, with an inflation, variable cost has an inflation of 3%. 3 to the power of 1. Okay, this is a cash flow, so we can have it as a negative here. Okay, now the formulas in cell B3, B4, okay, they can drag it across for the entire 4 years. Now the selling price for the selling price in cell B3, I can drag it across for the entire 4 years. Okay, the selling price remains fixed, so therefore you don't need to adjust your workings for cell B3, C3, D3, as well as E3. However, the variable cost is decreasing. So the variable cost is different. Therefore, you adjust workings here. Okay, from $10 to 10.2. That is the variable cost as at year 2 in current price term. Okay. In year 3, the variable cost is 10.61. Therefore, as at current price term, then 10.61. In in year 4, the current price, the variable cost is 10.93. Okay, before inflation. Okay, then I adjust my workings. Contribution per unit, therefore, is simply selling price, okay, minus variable cost. Okay, selling price minus variable cost to give, therefore, 20.9 year 1 all the way to year 4. If you can have here total contribution is the total contribution. There's no penalty in case you do a typo. Like here I have done contribution. No marks, no penalty for in case you do make a typo. Okay. Therefore, it will be equal to the contribution per unit. We multiply by the number of units of sale. In year one, the number of units of sale are equal to 520. Okay, 520,000. 520,000. Okay, I have the formula. I can drag it across the entire 4 years. Okay. Therefore, we can now be able to, year 2 is 624. I can adjust to 624 units, 624,000 units, 624,000 units, 624,000 units. Year 3, the number of units, they are 717. So I can adjust to 717. Year 4, the number of units are 788. So I can adjust this to 788. Therefore, the total contribution. As I was saying, you can be able to get total contribution in a go, in one working. Okay, that is in case you're confident. Okay, for example, okay, what I would have done, okay, total contribution was a simple TC will be equal to selling price. Okay, in one working, it will be equal to 30. Okay, times 1.04 to the power of 1, which is year 1 here. Okay, minus variable cost, which is equal to 10, okay, times the inflation 3%, 1.03 to the power of 1. I multiply this by the number of units. So don't forget the contribution needs to be in brackets, so open the bracket, close the brackets here, okay, times the number of units, which in year 1, the number of units is equal to 520,000. 1, 2, 3. And you get the same. Okay, so in case you're confident, as I was saying, you can do all this working in one working, okay, without the need for you to do selling price, variable cost, contribution per unit, total contribution, okay. But in case you're confident, because here, in case you make a mistake here, don't forget, not that you get penalized, okay, not as per se, okay. However, okay, the chance of making mistakes are a bit higher, okay. But in case you're confident, I think you have used Excel before and you're confident, then you can simply go and get the total contribution without the need for you to do every year selling price individually, variable cost individually, total contribution individually. Okay, so just it in one step instead of doing 4 steps. Anyway, it's you to make the decision. Okay, if you're not confident, then rather do bit by bit: selling price, variable cost, contribution per unit, total contribution. There you're just done. Okay, and whatever you're confident with, you're free to use it. Therefore, that's on the total contribution. Then the fixed costs of the company are increasing. They also are subject to inflation. And if the fixed cost is equal to 7, are they for inflation? Yes, they are. Look at this. The fixed costs of the company are in nominal terms. So therefore, we don't need to inflate them because they're already in nominal terms. Therefore, we don't need to inflate them because already inflation has been factored in. Therefore, there that is done for us already. Then the company can claim capital allowances on 25% reducing balance basis. There is therefore tax saving and tax savings on capital allowances as a result of capital allowances granted to you by the tax authority. So here I can have, I'll begin net book value. Okay, this therefore is the capital allowance CA. Then you can have here tax saving. Then tax savings. NBV, net book value, beginning of the year. So you can have this to be year 0, year 1, year 2, year 3, year 4. Sorry, year 4. NBV of this definitely is the cost of the asset because it's at year 0. The cost of this investment is 25 million. Okay, therefore 25 million. 25 million. Of course, year 0 don't claim. Okay, therefore you claim it in year 1, and you claim 25%. Therefore, 25% of the NBV, which is 25 million. That's what you claim. Therefore, in year 1, NBV end of year 1. Therefore, is the balance beginning of the year. Okay, minus, okay, what you just claimed, here therefore 18,50. Now you have the formulas in those two cells. Then you can drag the formula until year 3. That is a year before. Then do the same for the entire 3 years. Okay. Therefore, by the end of year 4, year 4 is the final year. Can you claim? Can you dispose the asset over 4 years with an assumed terminal value at the end of year? Okay, 5% of the initial cost. Okay, 5% of the initial cost. So scrap value here. Small short working here. Scrap value. Okay, 5%. Okay, of the initial investment cost, 25 million. Okay, therefore, the amount you can claim, the total capital you can claim, therefore, is equal to the amount you can claim here. Okay, is equal to the cost of the asset minus what you got back, which is equal to 1.25 million. Then the total amount you can claim by the end of year 4 is 23,750. 23,750. So in case there's a balance here, it will be therefore be claimed in year 4. Therefore be equal to the total amount you're meant to claim, 23,750, minus what you have claimed so far for those 3 years. Sum of all those 3 years. Therefore, you claim 29,296,000 in year 4, the balance that is. Okay. Total amount you can claim, 23,750 minus, okay, the total sum of the amount you have claimed so far from year 1 all the way to year 3. Clear? Thomas, that's clear?
Yes.
Okay, great. Therefore, the tax saving, don't forget, it is equal to the tax rate times the allowance will be given to you. The tax rate is how much? 30%, and you pay it in arrears. So therefore, 30% of the allowance given to you is a saving. Okay, from year 1 all the way to year 4. Okay, year 1 all the way to year 4. Anything else we have remaining? Okay, NPV payback, you're done. The maximum payback period is 2 years. Therefore, that is the point of, that's the benchmark. The real cost of capital of the company is 10%. The nominal is 12%. Don't forget to use the nominal because this is the nominal, this inflation. Okay, therefore you discount them. These are nominal cash flows in short. Okay, and you're done. Okay, therefore we can now get the NPV solution. Can begin to get in contribution for each of the year. We have done up there. So this is year. I'll begin with 0. Okay, year 1, year 2, year 3, year 4. Okay, contribution for year 1 is equal to. I can refer to my working above there. Okay, that's for year 1. I can drag now the formula because I've made reference to my workings are horizontal. Don't forget, you can do this in case you're working to a vertical. Okay, as I mentioned, that's why I prefer my workings to be horizontal, so I can make a reference a bit easier. Less fixed cost. Okay, there's a fixed cost. Okay, there's fixed cost. Okay, which will be equal to, this is a cash outflow, therefore I'll give my formulas are negative. Fixed cost, where is fixed cost here? I don't even need a formula. Negative fixed cost is 700,000. Okay, they're already in nominal terms, so we don't need to make an adjustment. So let me change this, the 700,000. Year 2, the fixed cost is 705. Year 3, the fixed cost is 779. Year 4 is equal to 841. Okay, that's not fixed cost. What else? Tax. Yeah, this is therefore cash flow before tax. This is cash flow before tax. Cash flow before tax equals the sum. Don't get I do the sum because my fixed costs are already in negative. Okay, that's for year 1. I have the formula all the way to year 4. Then let's pay tax. You're paying tax 1 in arrears. Therefore, tax for year 1 is paid in year 2, for year 4 in year 5. Therefore, the tax for year 1 is going to be equal to times 30%. This is a cash outflow. Therefore, I begin my formula with a negative because this is money you're paying, the cash outflow. Year 1 all the way to year 4. Don't forget, you have tax savings. So you have tax savings. which is also in arrears. Okay, we have the workings, therefore I can refer to my working above there. Year 1 was 1875, cash inflow, therefore is a positive. Then I can drag my formula all the way until year 4. Okay, what does it mean? Scrap value. You can dispose of this asset at the end of its life. Year 4, that is. Earn some money equal to 1.25 million. There's no working capital, and that is it. Okay, before cash flow. This cash flow, this is net cash flow. Okay, it will be equal to sum of cash flows all the way from the cash flow before taxation. Before I do this, actually, I think I need to do the initial cost. So let me put here. If I do this, initial cost, which was equal to negative 25 million. Yes, okay. No working capital. Oh, is it working capital? I can't even see working capital in the question. Working capital. I don't think it's working capital. No working capital. Okay, therefore net cash flow equals sum from the cash flow before taxation all the way until initial cost, year 1, or a diagonal formula all the way to year 5. How the cash flow there, then I can get NPV now. NPV will be equal to equals NPV. These are nominal cash flow, therefore you discount at the nominal rate of return. You discount therefore at 12%. You define from year 1, cash flow year 1, get the present value from year 1. Don't forget, you don't get the present value for year 0, okay, because it's already in present value terms, minus initial cost, which is 25 million. And again, therefore, 474 to be the NPV. Clear, Brenda?
Yes, it's clear.
What if you're being asked to get IRR? Okay, the same process, IRR. What if? It is a what if. You're not being asked here this question. What if? It will be equal to equals IRR. For the IRR, you define the cash flow from year 0. Okay, I think I've mentioned this before. Okay, you define the cash flow from year 0. So year 0 all the way to year 5. Okay, and they've given us the IRR equal to 30%. Okay. So therefore, you're going to make the comment regarding on whether to invest or not invest the money based on the NPV. This is a good project. Okay, therefore the company. Don't forget, always advise. It has a mark. The company should invest in the project. Should invest in the project. Since the NPV is a positive, since the NPV is a positive, you can even quote the value 10,474, 479. The company, in case you use IRR, okay, you don't require to do this example. The company should invest in the project since the IRR, since the IRR 10 over 30.07% is greater than the cost of capital, 12%. Next, you're meant to get the discounted payback period. Okay, therefore in that example, therefore I can have here my cash flows. Let me just copy my cash flows here. Double Control C. Okay, and you do know the shortcuts. Don't forget, you cannot copy. Okay, you cannot. There's no copy function. Okay, not copy function. It's there. Okay, but you have to use the this Control C, Control V. Okay, but you won't have the cut here copy. So you have to use the Control C, Control V. So here I have Control V. I paste my cash flows. I want the values only. Okay, then I discount them back to year 0. Okay, present values of the cash flows. This year 0, so I don't need to discount. So I discount year 1 cash flow divided by 1.12 to the power of 1. So let me just define this to be 1. This to be 1, 2, 3, 4, 5. Okay, I have the formula here. I drag across for the entire 5 years, and those are the present values. Okay. So I've done the present values. Therefore, next cumulative cash flow, cumulative cash flows. It will be equal to, okay, simply the cash flow beginning of the year, okay, plus the present value for the year, okay. Just a minute, will be equal to cash flow, okay, it will be equal to beginning year 0, it will be equal to balance beginning of the year. So we need to reclaim 25 million. So far you've got 99 million, okay, and 20,000. So I have the formula here. I divide across the entire 5 years, okay. Then, okay, before the end of year 1, you'll be able to get back your money because the sign here is changed from a negative to a positive. That means therefore, by the end of year 1, you wanted 15.9 million, and in year 2, you've already obtained 9 million. Just a minute. Now I need to lock this. Just a minute. Let me see. Let me lock this. So you have invested 25 million. You got back 9 million. No. Let me just do it manually. This formula is a bit crooked. And so you claim 25, you want 25 million, you got it back from what you've just made, 9 million. Okay, therefore what requires is an next 15 million. Okay, next, okay, you have 15 million, then you have claimed, you earn 9.2 million. Okay, you have to require an extra 6 million. Okay, I think I have the formula with me. Yes, okay, that's me. Therefore, in year 2, don't forget, at the end of year 2, you need 6 million. Then you have got that from year 3 cash flow, you got 9 million. Therefore, you have been able to claim more than even what you wanted by 2.3 million. Okay, that means therefore the payback for this company, for this project, is between year 2 and year 3. Therefore, I can say therefore the payback, which is discounted, okay, is equal to 2 years. Okay, how many months? How many point of the year? By the end of year 3, by the end of year 2, you require 6 million. Okay, therefore you require 6 million. Okay, this 6 million you're going to be earning from year 3 cash flow, which was 9 million. And therefore, you get 2.74 years to be the discounted payback period for this investment. Should we invest? No. Don't forget the maximum payback period that was needed was 2 years. This is below 2 years. Therefore, the company should not invest in the project. Since the payback, since the discountable period 2.74 years is beyond the target discounted payback period. Years. Clear? Valerie? Valerie?
Yes.
It's clear?
Clear. Yes.
Okay, great. So that's on that question. Don't forget, as I told you, expect a question by your examiner, either section B or section C. Okay, because they're quite straightforward question, not that they're any hard question. Okay, any other question you want us to do regarding the NPV, the IRR? Any question you may be having? Because in case you don't have, we'll go to the next topic. Okay, no question. Okay, then therefore assume that all of you are ready in case a question is tested regarding NPV, IRR, all those methods. You will be able to do them and do them well. Okay. Next topic I think was on finance, was on should we lease, should we buy? Okay, I think that is still part of the appraisal. Should we lease, should we buy? Anyway, I think we can do one question quickly. So in the lease or buy decision, don't forget this is a financing decision. This is not an investment decision, okay, on lease or buy decision, okay. And it's that as a company, when it comes to determining whether this is a good proposal or not, you base it on what you base it on the financing cash flow that results you either leasing or you buying that particular asset. Okay, so you're going to therefore quantify the financing cash flow that comes with either of those two decisions, either to lease or to buy the asset. And since these are financing cash flow, therefore you discount them at the company cost of borrowing, after tax cost of borrowing. Okay, that's what you have to be quite careful. Okay, these are financial cash flow, therefore we discount them at after tax cost of borrowing. Why? Because we assume that you are financed through a bank loan. Okay. Then let's therefore do a question. There's one question, okay, which I think I saw somewhere. Should we lease? Should we buy? You can do it quickly. How do I say it? Yes, it is. This is Melanie Company, page 92. So Melanie Company, page 92. You can do part. Okay, you can do A. You can do part A. Yeah, we do part A. Melanie Company, part A. So in this question, we have to get you evaluate whether the company should lease or should buy. Then you may determine the equivalent annual cost, okay, and recommend which replacement interval should be adopted. Okay, let's do it together. Okay, so use Excel definitely, because that's is what you'll be doing. Okay, should we lease? Should we buy? Let's do that evaluation. So in the lease or buy decision, don't forget we need to qualify, as I mentioned, the financing cash flow, okay, that counts with that particular proposal, okay. That is in case you lease, okay, or in case you do decide to buy the asset, okay. So let's therefore quantify the cash flow that comes with you leasing and the cash flow that would come in case you are to buy the asset. This was Melanie Company. A minute. Page 93, 92. Okay, I'm wondering what's wrong with my question bank. Okay, I see my question mark here doesn't have this Melanie Company. Okay, let me just take an image. Okay, wait with me. So you've been asked to get whether you should lease or should buy this particular asset. If you decide to lease, let's begin by leasing. You're going to pay 3 payments of 55,000. Okay, they're payable annually in advance. Therefore, you pay them in year 0, in year 1, and year 2. Okay. Alternatively, if that happens, therefore, there is no taxation, and the cost of capital is how much? The company can borrow, okay, at a loan of 8% per year. There's no tax, okay. So therefore, that's kind of for the cost of debt, because there's no tax. There's no before or after tax cost of debt, okay. Fair enough. Therefore, let's say lease option. Okay, lease option. So you're paying a lease rental in year 0, in year 1, in year 2. That is it. So the amount you pay, the cash flow, or the rent you pay, just call it rent. You pay. You've been told you'll be paying 55,000 each year. Beginning of year 1, which is year 0. Beginning of year 2, which is year. Beginning of year 2, which is year 1. Beginning of year 3, which is year 2. Okay, and so we get NPV. Therefore, the present value we simply is NPV. NPV. We discount them at the cost of borrowing, which is 8%. You define the cash flow from year 1, okay, plus the present value. Don't forget year 0 is already in present. It's already in present value term. So therefore, you don't need to discount it. And you get therefore 150,000. Therefore, the present value, the sum present value of cash flows, if you had to do the lease rent option. Okay, what if now you do the purchase option? Okay, this is purchase option. If you do the purchase option, okay, you in year 0 you buy the assets. Year 1, the life of this asset is how long? 3 years. It's life of 3 years. Year 3. So, cost in year 0 you buy the assets. Purchase cost. So in year 0 you buy the assets. How much do you pay? You pay the cost of this machine is 160,000 cash outflow. 160,000. All these are cash outflows. Actually, let me put them as they should be. Okay, purchase cost, cash outflow. And then the machine is purchased. You look at a maintenance. If you purchase, then you do pay a maintenance. So maintenance cost, if you purchase, that is maintenance cost, equal to how much you pay per year. You pay 8,000 per year, payable at the end of each year. So you're paying end of the year, and you pay 8,000 negative cash outflow and negative cash flow, and the same amount is paid for the 3 years. Okay. And what else? The machine has a residual value of 40,000 at the end of life. So here, disposal value, scrap value, cash inflow. Okay, which are in year 3, and there's a cash inflow of 11,000, and that is it. Okay, cash flow. Year 1, simply do the sum. For year 0, and the sum of the cash flows you have there. Year 0 all the way to year 3. Once you've done that, you get the present value cash flow, which will be equal to NPV. We define from year 1 cash flow. So year 1 all the way to year 3, okay, plus year 0. You've entered 2 few arguments. What have I done here? Okay, I did define the cash for the cost of capital. So let me define the cost of capital is 8%. 8% is the cost of capital. And I get 1.1884. Okay, in case we do therefore the purchase option. John, that's clear?
Question.
Yes.
The scrap value of 11,000. Should use 11 or 40?
Oh, is it 40? So what do you get 40? No, it's just 11,000 there. Why would you want to use 40?
The second paragraph.
Oh, have I mixed them up? Okay, I've seen. The machine would have, it's the residual 40, thank you. Would have a residual 40,000, not 11,000. So I think I read the wrong paragraph. Yes, okay, I think I had read the wrong paragraph. The machine would have a residual value of 40,000 at the end of its life. Yes, thank you, John. Okay, again, they have a 40,000, okay? As a cash inflow, as a scrap value as at year 3. Then you can advise the company, should we lease, should we buy? And if you look at the cost, definitely you need to purchase, because this is where you have the lowest cost of 148 compared to the option of leasing. Therefore, the company should lease the assets, the company should buy the assets, should buy the assets. And this machine, okay. Machine, should buy the machine, since purchase option, since the purchase option the lowest present value cost as the lowest present value PV of cost. Okay, that's the first. That's in number 1. Number 2, you're meant to use the equivalent annual cost. Yes, Timothy, Thomas.
The cost of capital was not taken care of.
We have. Why not? We have done it here 8%.
Okay.
Yes, 8%. We are discounted at 8%, the cost of borrowing.
Okay, thank you.
Okay, great. Yeah, therefore, 148,000. Therefore, it's better for a government purchase as opposed to leasing, because in case you lease, this is what you get it. If you purchase, this is what will be the cost to the company in present value terms. So number 2, you mean us to get when we should make the replacement based on the equivalent annual cost. Okay. The knowledge is made that in the maintenance, if maintenance routines were upgraded, the new machine will be operated at a period of 4 years. So we do 4 years. Maintenance would increase by 12,000 per year, payable at the end of each year of the operation. Payable at the end of each year operation. If operated for 4 years, the residual value would fall to 11,000. Okay. So what therefore would be the residual value for year 1, year 2? So you only want to do year 3 and year 4. Okay. You only want to do year 3 and year 4. Okay, fair enough. So there it's simply 2 years, year 3, year 4. So maybe a 3-year replacement, 3-year cycle, replacement cycle. Therefore, I have year 0, year 1, year 2, year 3. Okay. So here, purchase cost of the assets. Which is equal to, we have already done, which is equal to 6,000. Maintenance cost.
4 years.
No, you have to do the two of them, 3 years and 4 years. Do you see that question?
Yes.
Yeah, so you have to do both of them, a 3-year cycle and a 4-year cycle.
Okay.
So for now, you're doing the 3-year cycle. So maintenance cost would be equal to, okay, you ensure that in case the new machine will be operated for a period of 4 years, okay, with the maintenance cost increasing to 12,000 per year, payable at the start of each year operation. So the maintenance cost increased from 8,000 to 12,000. So every year, therefore, you're paying 12,000. Therefore, maintenance cost of 12,000 every year for the 3 years. So you can drag for 3 years. Okay. What else? Scrap value. So here, finally, you have the scrap value of the asset, cash inflow, which is equal to 40,000 as it was even before, 40,000. Okay. That is it. Okay. We can have cash flow. This is a 3-year cycle. We use the asset for 3 years. Okay. And then we shall compare with a 4-year cycle. Okay. For 3 years, the cash flow will be equal to. Okay. Present value cash flow, therefore be equal to NPV. We discount the current cost of capital, which is 8%. We define from year 1 all the way to year 3. Okay, minus 160, and you get negative 159, 171. That's the total present value cost. Equivalent annual cost will be equal to the cash flow, which is 159, 171, we divide by the factor, okay, the factor, okay, I think here I need a table. The factor of 8%, 3 years, okay, factor 3%, 8 years. I don't know whether I have a question. Back with me. Let me see if I have a question. I have the tables with me here. I should have 8%, 3 years. The factor 8%, 3 years. I think I have one here. 8%, 3 years. Okay, this is from the table. 8%, 3 years. I get 25.77. For 25.77, so I divide 25.57. 25.77. So therefore, divide by 2.5, 2.577. Therefore, every year you shall be incurring a cost of 61,766. Okay. So for example, is the present value of cash flow 159, 171. You divide by the present value earned factor 3 years, 8%. Then if you do a 4-year cycle, a 4-year cycle, same process, okay, maintenance cost. Let me just copy these because the same purchase cost, maintenance cost mean the same. Okay, and Control C. Don't get, you can now be able to do that in since you're using Excel. Okay, maintenance cost the same. However, the scrap value, I think is changing. It is decreasing to 11,000. If I let me check the question again. Okay, for 4-year cycle, the maintenance cost, the CO value falls to 11,000. Therefore, 11,000. And I have the formulas already. Okay, and I get an NPV code 1 is 2. The cost, this now I need to change. Okay, because this is 4 years. Okay, the factor, the earned factor 4 years 8% is equal to. Let me go back to my table. 4 years 8% 4 years is 33.12. That 33.12. So therefore 33.12. And I get a cost of 55,000. Get a cost of 55,000. This is the cost per year if the company was to use a 4-year cycle. Then now you do the company, okay, which is a better time to replace the assets. Of course, therefore, is at the end of year 4. Why? Because the cost of the company is minimal. The cost per year is minimal as a 4-year cycle. The company should replace the assets, at the end of year 4. Since a 4-year replacement cycle, 4-year replacement cycle has the lowest equivalent annual cost. Clear? Mercy?
Yes.
Okay. So that's on.
Question.
Yes, yes.
Should we do for the year 0 to year 4 or
Year 0 to year 4. What do you mean by year 0 to year 4? John?
For the 4-year period.
We do from year 0 to year 4.
I'm asking, yes, that's what I'm asking.
I'm not getting your question very clearly, John.
We've done for the 3 years, from year 0 to year 3.
Thank you. Because these are 4-year, okay? I forgot, I just copied. Thank you, John. Yes, thank you. Don't forget, this is 4-year. Thank you for that. These are 4 years. Therefore, okay, this replaces this curve value is not in year 3, it's in year 4. Yeah, thank you, John. So let me just accept this. Should not be a lot of work because so this is until year 4, present value all the way to F29. Thank you. Does it change? Actually mean that it says yes, we do from year 0 all the way to year 4, not to year 3. Okay, I think I'd stopped at year 3, and this is a 4-year cycle. Thank you, John. Any other question? Don't forget, there'll be a question in the exam by there, as I told you, on that area of innovations, decision making. Okay, there'll be a question in your exam, either section C or even section B. Okay, so, or even both. Okay, so expect a question from your examiner. Any question before we leave that area? Okay, no question. The next area we are discussing was on finance sources. Okay, was on finance sources. We see that the company can finance itself from two main. We can classify the company finance sources in two main categories: short-term and long-term. Short-term, we discussed four of them: overdraft, short-term loans, leasing, okay, as well as the use of trade credit. Okay, in the case of long-term, we discussed you can use from equity financing. Okay. Where the equity financing, you can obtain money from issue shares. You can use the company past earnings. Okay, you can use the company efficient margin, its working capital. Okay, all these are company internal your equity financing alternative. Okay, in the case of issue shares, we did say that the company can issue shares from a number of alternatives, either at an IPO point, okay, at a placement point, introduction, right issue shares. Okay. In the case of debt, we say that the company can finance itself using a number of ways. Okay, it can issue bonds, okay, as well as it can issue, it can use, okay, bank loans, okay, long-term bank loans. In the case of the bank loans, in the case of the bonds, okay, we say the company can use a number of bonds, okay, bonds that are redeemable, bonds that are irredeemable, okay, bonds that are convertible, okay. So a number of array of bonds the company can use, okay. So let's pay attention to the right issue share, okay. To us, the right of share, okay, we lease the company. This is where the company offers the current shareholder the option, the alternative of being able to buy the company. They could buy extra company shares at a discounted price, okay, to buy the company extra shares at a discounted price, okay. Now, what that means, therefore, is that, okay, the option is only available to you as the current shareholder, okay. It is not available to other members of the public, okay. But in case you don't take out the offer, the company is offering you, then don't forget it means you are forfeiting your right, okay, to the company, and the company can decide to sell those extra shares they're offering to you, okay, at a discount at the market, at what price they deem it fit. But you mentioned it is not worthwhile for you to do that, okay? Why? Because it will be a reduction in your wealth, okay? We said it is possible for you to be able to estimate what should be the share price, okay, at the expiry point, okay, or at the expiry of the offer, okay, what referred to as the theoretical exercise share price, okay. You can estimate, okay, what should be the share price upon the completion, upon the exhaustion, okay, of this offer, the expiry of this offer to the members of the public, okay. And you see that when it comes to this alternative, okay, if the share price of the company is going to be at the theoretical exercise share price, okay, if the share price upon the expiry, okay, don't forget this theoretical exercise share price is simply an estimation. We're trying to estimate what would be, okay, the company share price after the expiry, okay. So it's a forecast, sort of, it's a forecast, okay. So if the actual company share price will be at the theoretical exercise share price after the expiry of the offer, then the shareholders' wealth remains constant. If the share price will be higher, then that's it. Therefore, an increase in the wealth. If lower, then a decrease in the wealth. Clear? And don't forget, as I mentioned, don't forget these rights have a value because they're not available to any member. Therefore, they do have value. So therefore, it is possible for you to sell off the shares being offered to you at the discounted price. Okay. Therefore, they have value. Therefore, it is possible for you to sell those shares at a discounted price. Okay. And you see the value of the share, the value of a right. Okay, you can estimate the value of a right. Okay, in two ways. The value of a right. Okay, we said it's given us. Okay, let me just draw. That the value of right can be defined in two ways, depending on how you define the number of rights to be equal to. If you define the number of rights to be equal to the current, okay, or the existing number of shares, then say therefore the value of a right therefore is equal to the drop in the value of these shares. Okay, that is from the current market price, they drop to the theoretical exercise share price, that the value of a right. If we define the number of rights to be equal to the new share you'll be getting as shareholder, then the number of rights equal to the increase in the value of this share, okay, from their offer price, okay, don't forget you bought them as the offer price to the theoretical exercise share price, the increase in the value from the offer price to the theoretical exercise share price, okay. So it depends, therefore, how do you find the number of rights to be equal to, okay, that's how therefore it will depend on the value of rights, depending on how you define the number of rights to be equal to. clear? Okay, I suppose that's clear. So we can do a quick question here. I don't know if you have done this question. By the way, don't forget this is your revision. So I should not be the one who's giving this question. So in case you have a question, let me know. So don't let me be the one to give these questions. This is your time. It's here to guide me the areas where you're still weak. And I don't know whether they've done this question. Have we done this question? This tin company.
Yes.
Okay, you've done that. Let's look and we can get another one. On right issue share. Okay, then go to this question. There's a question where, okay, there it is. Have we done this question? Green Up Company. Page, Green Up Company, page 65. Green Up Company, page 65.
No.
Okay, fair enough. Then go through it. We discuss together. Green Up Company, page 65. Page 65, Green Up Company. Time to do it together. So here, don't forget you're meant to make an to evaluate, okay, as whether if you are a shareholder in this company, would you vote, or in case you're being called upon to contribute to the money of the company, would you contribute? Is this worthwhile? Okay, that's the question. Is it worthwhile for you to put your money in this company? Okay, based on where they want to invest the money into. Okay, so let's switch. It was page, what, just a minute, page 65. Page 65. So inside the question, don't forget the first step is to determine what is the benchmark share price. In short, what's the theoretical exercise share price? Okay, because if the share price after, okay, is going to be higher than the theoretical exercise share price, then that's therefore a good proposal. If the share price after this investment has made is going to be lower than the theoretical exercise share price, then that's a bad investment. Okay, so therefore reject the proposed use of funds. Okay. Therefore, you need to compare with the theoretical extra share price. So therefore, the first step is determine what is the theoretical extra share price, okay, for the based on this offer. Okay. So that's kind of for the first working. We determine therefore the theoretical extra share price. Okay, theoretical extra share price therefore be equal to this offer. Okay, you're being told the company wants to raise money and use that money to pay off a debt. Okay, so the offer is 1 for 5. Okay, so you're going to get 1 new share. That's you're going to get 1 new share, and the amount you pay to get this 1 new share is how much? How much do you pay? The offer price, the current share price is 3.5. The offer is 20% discount. Therefore, let me just here can do the offer price here. over price, therefore, okay, will be equal to 80% of the current share price, 3.5, to give therefore 2.8. Okay, therefore you say that going back to get the theoretical share price, to get one new share where you pay 2.8. Okay, for you to get this one new share, you must have 4 odd shares. Is one for 5? Sorry, yes, you need to have 5 shares. Okay, 5 whose price amount of the price is 3.5. So you must have 5 shares whose price is 3.5. Therefore, combined, the total number share be having is equal to 6. Therefore, you divide therefore this by 6, and you get therefore 3.38. Therefore, the theoretical exit share price. Okay, we just repeat, is therefore equal to 1 times 3 times 2 times 2.8, the offer price, plus the value of the 5 old shares, which is 5 to 3.5. We divide by the total share you have after, which is equal to 6. Be careful that you need to have this in brackets. Okay, this entire equation need to be in brackets. Okay, so the denominator, okay, is open inside the bracket, and you close the bracket. Okay, this is one of the questions, one of the concern your examiner had, that you guys, you forget to put brackets. Okay, you put brackets in the appropriate areas. Okay, they'll get all this from 1 to 3.5. Okay, don't forget that is in itself, that is the numerator. Okay, 6 is meant to divide the entire equation above. Okay, therefore be in the bracket, you add the bracket. Anyway, I know you're not like that. Okay, and you won't fall into that trap. Anyway, so that's the benchmark there for share price is 3.38. So in case the company goes ahead with this proposal and the share price will be above 3.38, that's a good proposal. Okay, it is increasing wealth of shareholder. If the share price will be at 3.38, that's this, and maybe you remain where you are. Okay, if the share price becomes lower than 3.38, then that's a bad proposal. It indicates a decrease in the wealth to the shareholder. And let's do the evaluation. So first we determine, okay, how much money is the company going to raise? The company wants to raise 11.2, out of which 280 is going to is cost. The company is initial cost. Therefore, the net cash flow, the net cash to be received from this offer, 11.2 million minus 0.28. Okay, therefore 10.92 million. Therefore, the net amount of cash the company will be raising, okay, from this proposal, 10.92 million. Next thing is that you're going to use this money and pay off the debt holder. How much do you pay per bond? The amount you pay per bond is equal to 5% premium from the current market value. Therefore, let me call, how do you call it? Redemption or repayment, we call it payment price per bond. Repayment price per bond. A bond will be equal to, it's 5%. Okay, times the current market value, which is equal to 104. 104, yes. Therefore, you pay 19.2 to be the amount you pay per bond. Okay, this is repayment. Okay, therefore, the next question, therefore, how many bonds? Okay, the amount you have is 10.92 million. You're paying $109.2 per bond. Therefore, how many bonds do you pay back? Okay, number of bonds bought back, or bonds bought back, therefore, will be equal to the amount of money you have, which is equal to 10.92 million. 10.92. Okay, we divide by the amount you pay per bond, and the amount you pay per bond is equal to 109.2. Therefore, the number of bonds you are going to be buying back is equal to 100,000. Next, we get what's the nominal value of these bonds? Okay, the nominal value of these bonds, okay, the one you just bought back is 100,000 bonds times the nominal value per bond, which is 100. And it means you have bought back bonds worth, okay, with a nominal value, a book value of 10 million. So since you have repaid, therefore going forward, you will be paying the interest of the 10 million. Then how much interest therefore do you save? Now this interest, you used to pay 8%. Therefore, the interest saving, therefore is equal to 10 million, okay, 10 million times the 8%, the amount to be saving, the interest will be saved per year. which is equal to 800,000. Now, don't forget, this is a saving you have made. Don't forget, you have to pay tax on the saving. This is like an income you have made. Therefore, you pay tax on it. Therefore, net saving after tax. You pay tax. You pay tax. I'm not sure they pay tax here. Yes, that percent. You pay tax on that percent. Okay, that percent. Therefore, it is 1 minus 0.3. But that percent is tax. Therefore, you remain with 20% times the interest, the gross interest saving. Therefore, you save therefore 560 per year. Okay. Now, before the company came over, before this proposal, the company had an earning of how much? The earning per share currently is 0.42. Okay. The company has total earnings of 8.4. Therefore, you can say therefore revised earnings of the company, after this proposal is equal to 560 plus the 8.4 million, 840. Yes, John.
Could you, after your current work, could you please repeat the net saving?
The net saving. Okay, here is the net saving. Don't forget, the interest you pay is based on the nominal value. So it's not based on the market value. Okay. Therefore, you need to get the nominal value of the bonds they have bought back. Okay. So first, you determine how many bonds have been bought back. Okay. Sorry. So first, the number of bonds bought back is equal to 100,000 bonds. Why? Because you have 10.92 million. The amount you have, we need to pay per bond is 19.2. Therefore, you buy back, therefore, 100,000 bonds. Clear there?
Yes.
Therefore, the nominal value, don't forget, the nominal value per bond is 100. Therefore, you multiply the number of bonds times 100. Clear?
Yes.
The interest you pay on the bond is 8%. Therefore, how much therefore do you save? 8% of 10 million, which is 800,000. Then the tax. Okay, this is interest. This is an income we have made. Okay, therefore you pay tax on that percent. It therefore remain with therefore it's 560. Clear there?
It's clear.
Okay, great. Therefore, now we can get earnings per share. Don't call this a revised earnings per share, or the new earnings per share, whatever you want to call it, revised EPS. So first of all, this is total earnings of the company. We divide by the number of shares, the new number of shares. Okay. So first of all, we need to determine how many shares do we need to issue. That's, I think, the working we need to do. For us to get 11.2 million, we need to issue how many shares? I think that should be the working that. Let me first. Okay. So here, the new number of shares. You need to issue. First, the amount of money you need. The amount of money you need is 11.2 million. 11.2 million. Yes, you need 11.2 million. The amount you get per share you'll be issuing is 2.8. Okay, 2.8. That means you'll be issuing 4 million new shares in the market. For you to get 11.2 million, you need to issue 4 million new shares. Current number of shares you have. The current. What is this? Clean up company. Okay. The current number of shares. If you look at the company P&L. Okay, so it has the total number of shares, the nominal value of company share is 10 million. One share has a nominal value of 0.5. Therefore, the odd number of shares, let me just call it odd equals. Okay, is equal to 10 million. You divide by 1, 2, 3, 1, 2, 3. You divide by 0.5. That's 10 million, yes, 12 million. Therefore, currently this company has 20 million shares. They have total number of shares. Total number of shares. It will be equal to 24 million. As I told you, don't forget, I would be happy in case you don't use calculator in section C. Okay, so all your workings, so that all your workings are on that particular Excel. Okay, then again going back, the revised number of share, the revised earnings per share, therefore, is the new earnings divided by the new number of shares, 24 million, and you get therefore that 7 cents. Okay, we get therefore that 7 cents. We get therefore the revised earnings per share. Now we make an assumption that the company price to earning ratio, okay, will remain constant. Okay, remain constant. Okay, therefore the current MPS, therefore PE ratio is 3.5 divide by the current earnings per share, 0.42, and you get therefore 8.33. Therefore, the share price that we extract after this investment has been done, extract the share price. Then we go to the P ratio times the revised earnings per share. P ratio times the revised earnings per share of that 7 cents, and get 3.11 shillings dollars. Clear, Brenda?
Could you repeat the P price to earning ratio?
Or the price to earnings ratio. The current PE ratio, don't forget the PE ratio simply, let me just give the formula, is equal to MPS divided by earnings per share. Okay. Therefore, current was MPS 3.5, isn't it? Or was the current earnings per share 0.42? Clear, John?
Yes.
Oh, great. Therefore, we get therefore 8.833. Now we want to determine what therefore is the share price that we expect. The P ratio, don't forget, is MPS divided by earnings per share. Therefore, we go to the MPS. Therefore, the MPS therefore will be equal to P ratio times earnings per share, which is what we've done here. P ratio 8.33, okay, which you have here, times earnings per share revised 0.37, and we got therefore 3.11. Clear, Thomas?
Not yet. How do you get 8.96?
9.6. Don't forget, this is the old earnings per share, which was how much? 8.4 million, isn't it? Earnings per share in the old policy. What sort of earnings the company before? 8.4 million, isn't it? As for the question, it's given in the question. The company current earnings is 8.4 million. Given the question there.
I've seen it.
Seen it?
Yes.
Plus 560. The savings here, the net savings we are making 560.
I've seen.
Okay, great. In the question. Okay, another question. Okay, therefore now we can therefore make a comment. Should we? Is this a good proposal or not a good proposal? This is not a good proposal because don't forget to say that the benchmark is the theoretical extract share price, but now the share price that we extract is 3.11. This is not a good proposal. It will be an indication of a decrease in the to the shareholder. Therefore, we comment. Okay, the proposal. The proposed use of funds. The proposed use of funds is not financially acceptable since the share price, the expected share price, $3 is 3.11 is lower than the theoretical exercise share price 3.38. Clear? Mercy?
Yeah.
Okay, that's on variety of share. Next, I think I'll do a cover cap. Any question before we move on?
Yes, question.
Yes, John.
Should since if the share price is higher, doesn't that mean that the shareholder wealth is increasing?
The share price is 3.11. It's not higher. Why do you say it's higher?
Oh, sorry. I had mistaken.
Okay. Okay, so that's on the right issue share. So if this question comes, these are free marks. Okay, I guess. Okay. Next, I think we're gonna get the for cost of capital. Okay, and you see the cost of capital. Don't forget cost of capital here. The steps that you follow. Okay, so these maybe the first thing is the steps we follow. Okay, on cost of capital first is to get the market value. To determine where the capital is coming from. So get what we call the capital sources. Okay. Next, we need to get the market value of those capital sources. Okay. Next is to identify the cost of capital from each one of them. Okay. And lastly, what do? We get the weighted average cost of capital of the company. Okay. Those are the steps that we follow. First, identify what are the capital sources of this company. Get their individual market value. then get the cost of capital from each one of them, and lastly, get the weighted average cost of capital. Okay. And we do a question. Any question you have in mind, can do to discuss on this area? Okay, you don't have anyone in any question in mind. Let's look at a question which we have not done. Just to revise on that area. So let me go to the recent questions. Okay, so you can get one question. Cost of capital. Okay, there's a one here. Let's see. Have we done on this coffee company? This is page 90. Coffee company, page 90. Coffee company, page 90.
No.
Okay, fair enough. Then go through it. We discuss together. And we do so through Excel. So we were told that we need to get the cost of capital for the company. Okay, we did average cost of capital on market value basis. So the first thing to know where the money is coming from, the cost of the capital sources. There's equity, there's 8% preference share, there's 8% notes, and there's a bank loan. So they're coming from 3 sources. Okay, so capital sources. There are 4 of them. So we have equity. We have, what else do we have? We have 6% preference share. So we have preference share. We have loan notes. We have bank loan. Okay, so those are the 4 sources of company finance. Next, you get the market value. You can get therefore their market values. So let's begin by getting the market value of equity. You can format, you can maybe, I don't know, you can use bold, you can use italic, but no marks. You can format it the way you want, but don't waste your time formatting. Anyway, so that's the source of capital. So let's get the market value. The company, the total nominal value of the company on the share is 15 million. One share has an ordinary value, a nominal value of 1 million. Therefore, the number issued share for the company is 15 million shares. 15 million share. 1, 2, 3. Yes, 15 million shares. Okay. We multiply by the market value per share. The market value per share of the company is 6.1. We have times 6.1 together for the total market value of the company share. Okay. The market value of the company preference share is the number of preference share. The nominal value is 6 million. The preference share nominal value is 0.6, 0.75. Therefore, the number of preference share of this company is 6 million. 1, 2, 3, 1, 2, 3. Just confirm. Yes, it is correct. Sorry. Divide by the nominal value per share, 0.75, times the market value per preference share, which is 0.64, 0.64. Okay, the market value for preference shares. Next is the notes. The note have a market value of 103.5. So therefore, the market value of the notes of the company will be equal to the nominal value of the notes, which is 8 million. 8 million. Yeah, that's okay. Times 103 divided by 100, 101, what's that one? 103.5. Let's give the market value for the notes, okay, which is equal to 8 million to 80,000. Next, the bank loan doesn't have market value, so use its book value 5 million. Okay, therefore, the sum of the market value from the four sources is able to do the sum. Okay, therefore, 109.9 million. Okay, what else? Now, next, we can get the cost of capital from each one of them. Okay, for each of the capital source. So, capital cost of capital from each one of them. Okay, I think we can do the working for that. So let's begin the equity. There they are, cost of equity. We can use two models. We can use the capital as a pricing model, or we can use the dividend growth model. So as per the information given here, there is some dividend given. So I would propose that we use therefore the dividend growth model, which is equal to, so it could therefore be equal to D naught 1 plus G. D naught is equal to 0.9. The growth in dividend is how much? The company just pay dividends equal to. There seems to be no growth in dividend here given to us. So we assume there's no growth in dividend. The company just pay dividend for 0.9. Actually, we have been given here, I think we can use the capital as a pricing model because we give all the information that we need. Okay, because we know that the company has a cost of equity, a risk-free. The risk-free return is equal to 3.5. Therefore, I can put therefore 0.035 plus the beta 1.25 times the equity risk premium, which is equal to 0.068. Don't make a decimal in percentages. Okay, so if you want to use percentages, use percentage throughout. Okay, if you want to use decimal, use decimal throughout. Okay, so I want to use my decimals, so that's why I haven't converted them into percentages. Okay, and therefore we get that's with the cost of equity, which is 12%. Don't forget what I've done here is cost of equity is equal to risk-free plus equity beta. We multiply by return on the market portfolio minus risk-free. Now this is what referred to as the RM minus RF is referred to as the equity risk premium. Okay, therefore this is equal to how much is it? 3.5% plus equity beta 1.25 times the premium 6.8%. Is what I've just done here, 12%. Yes, Thomas.
Please let me on loan notes. How do you get 82?
Oh, see, how many notes do we have? We have a note equal to 8 million divided by 100, isn't it?
Yes.
Times 103.5. 8 million divided by 100 times 103.5. That's what I get. I got 8220. You get a different figure?
8280.
Yes, I get 8280. Do you get a different figure yourself? $8 million divided by 100 times 103.5. What do you get? Okay.
Correct.
Okay. Therefore, that's together for the company, the cost of that's together for the cost of equity, 12%. Okay, and I can refine it here because the capital for equity equals, we've done the working, 12%. Next, you can get the cost of preference share. So cost of preference share, which is equal to, okay, don't get preference share cost. Okay, let me just do a formula here. Is cost of preference share is equal to preferred dividend divided by P naught, we express as a percent. Okay. Therefore, can see we therefore feed into that information. Preferred dividend for this company, for this equity, this preference share is 6%. Therefore, the preferred dividend, okay, therefore is equal to 6%. Sorry, 6% times the nominal value, 25 cents. That's the preferred dividend for this particular company, for this particular share, divided by the market value P naught, which is equal to 64 cents, 0.64. And again, therefore 7%, therefore to be the cost of this previous share. Don't forget, how I multiply by 100 because I want my figures to be in decimal. Okay, if you want to multiply, no problem, but don't mix the two. Don't mix the percentages and decimal. Okay, that's the cost of previous share. Then cost of bank loan, cost of the bank loan, cost of bonds, sorry, cost of notes. The cost of the notes, okay, for this company. This note, let me go to the details. It can be redeemed in 5 years' time at 10% premium to the market value. Currently, it is paying at 8% note. Therefore, I guess you can get here the interest. The interest you're paying here is you'll be paying to the holders is 8%. Sorry, 8% times the nominal value of the bond, 100. Do you pay tax? Yes, the 20%. Therefore, the net expense of the company is therefore 8% of that. Okay, 0.8 because it is 100 minus 0 by the tax, which is 20%. 6.4. What else? Redemption value V is therefore 110 because it's 10% premium from the market value. Market value 3.5. I think we have all what we need to get the cost of this bond. Let me delete this. Okay, therefore I want to use the IRR formula. Okay, therefore I can be in here year 0. How many years? 5 years. Year 2, year 1, year 2, year 3, year 4, year 5. So from year 1 all the way to year 4, I'll be getting an interest equal to 6.4. Equal to 6.4. Okay. Let me lock this. Okay, then in the final year 5, don't forget you're going to get the interest plus the redemption value, which is equal to 110. You have it here, is equal to 110. Then P naught, the current market value of the bond is how much? 103 negative. Don't forget B negative 103.5. Therefore, the cost of the debt RD simply is IRR equals IRR. I define the cash flow from year 0 all the way to year 5, and I get 7%. Okay, therefore cost of the notes therefore equals cost of the private share. I've done that already, equals 7% here. Cost of the loan notes 7%. I've done here. Don't forget, I'm not going to hold down the percentage here, so it is Excel that has done automatically a 7%. So don't confuse. Don't put percentage. If you want to use decimal, use decimal. Okay, so don't multiply by 100. I would close it, don't multiply by 100 because you're going to end up mixing them up. Okay, and you're going to get up with the wrong answer. Anyway, so that's it. We do the cost of the bank loan. The bank loan has a variable interest rate. Okay, which means therefore the cost of this bank loan will be the cost of any other debt instrument this company has. Yes, John.
Could you repeat the IRR input?
Oh, the IRR. Okay, so the IRR here, what I've just done simply is define the cash flow, and you define from year 0. Okay, you define from year 0 all the way to year 5. Don't forget, year 0 is a negative. Okay, that's I think the trick you can forget. So in year 0, don't forget, if you remember, let me just, this is from the formula which I think we already know. 0 is equal to negative P naught plus interest time present value factor 5 years R% plus redemption value, okay, time present value interest factor 5 years R%. Okay, you begin with a negative here. This is a formula, but now in the use of the IRR formula in Excel. Clear, John?
Clear.
Okay, great. Okay. So, and the hotels. And so since this bank loan you have here, as I mentioned, it has a variable interest rate. Okay, so if we have a loan that has a variable interest rate, what do you do? How do you get the cost of the debt? You're going to therefore first, in case you have its history, ensure that last year this is what you paid. Then you can assume that what you paid last year is what you paid this year. Okay, you can do that assumption. If not, therefore, you identify, does this company has another, okay, a bank loan? Does it has so not a bank loan, does it have another debt instrument? The cost of that other debt instrument becomes the cost of this bank loan. So in this example, we don't have the history of the interest the company paid on this loan. So what do? We look, do we have another debt instrument? Yes, we have this particular bond. Therefore, the cost of this bond becomes the cost of the bank loan. That's an assumption. Therefore, the cost of this therefore becomes the cost of the bank loan, which is 7%. Don't forget, I'm not of that this percent is here. Okay, so don't, if you want, don't, if these are decimals, all of them. Okay, for markets, all these are decimals. Okay, I propose that you do that. Otherwise, you're going to mess up. And now here I can get the company cost of capital, okay, which will be equal to the weight. Okay, first I think I can get the weight. Okay, don't need weight. The weight therefore will be equal to the market value divided by the total market value, which is 109.9 million. So since this is a constant, let me lock it. Yeah, this is, let me lock it. Okay, this is the weight times the cost. The weight times the cost, which is 12% or 0.12. The weight times the cost for each one of them. Weight of equity times its cost, weight of preference share times the cost, weight of loan notes times the cost, weight of the bank loan times the cost. Okay, that's for the first one. And I can drag the formula now. Therefore, the company cost of capital, we have a cost of capital, therefore, it will be simply the sum. Okay, the sum from the equity all the way to the bank loan. And I get therefore 11%, 11.7%. And that is it. Question, Valerie?
No.
It's clear. Okay, great. It was clear. Any other question? Thomas?
I've seen.
Okay. So any other question from any other topic? Because I want to have the class there in case there's no other question.
Question page 56.
Sorry, page 56?
Question 3.
56, question 3. Okay. Page 56, question 3. Okay, page 56, question 3. That is as per Thomas' request. Page 56, question 3. 56. Question 3. Are this on PZK? Thomas?
Yes, yes.
Okay, we do part, which part? A, B.
A and B.
A and B. Okay, fair enough. But then page 56 on PZK company. Go through it, we discuss together then.
Yes.
Ask.
In this part B.
Part B, yes. Part
Where we'll use the second quotation for the 12-month forward exchange rate.
Yes, you can use it. I've used the first quotation. You can use the second quotation.
Oh,
And I hope that they give you the same answer. You can use the first second quotation.
Okay.
Yes. Any other question? Okay, fair enough. Then when I do the exam,